Investing in emerging markets, risks and rewards. Introduction. Emerging markets (EMs) have long been attractive to investors seeking high growth opportunities. These markets, often characterized by rapid industrialization, expanding middle classes, and increasing consumer demand, present the potential for significant returns. However, they also come with unique risks such as political instability, currency fluctuations, and less developed financial systems. As globalization continues to connect the world's economies, emerging markets have become an increasingly important component of investment portfolios. In this article, we will explore the risks and rewards associated with investing in emerging markets, providing a comprehensive understanding of the opportunities and challenges for investors. Number 1. What are emerging markets? Emerging markets refer to economies that are in the process of industrialization, modernization, and significant growth, but have not yet reached the economic development level of developed markets. These markets typically include countries in regions such as Asia, Latin America, Africa, and Eastern Europe. Emerging markets are characterized by rapid economic growth, a bargaining middle class, increasing access to education, and a shift towards market-driven economies. However, these nations also tend to have less developed infrastructures, volatile political environments, and a reliance on key industries such as agriculture, energy, and manufacturing. This section will define emerging markets and explain the characteristics that distinguish them from developed markets. Number 2. The potential for high returns. One of the primary attractions of investing in emerging markets is the potential for high returns. As these countries industrialize and modernize, their economies grow at much faster rates than those of developed nations. Emerging markets offer investors the chance to capitalize on the rapid expansion of sectors such as consumer goods, technology, infrastructure, and energy. For example, many investors have seen significant returns from the rising stock markets of China, India, and Brazil, where rapid economic growth has been accompanied by increased demand for goods and services. This section will explore the potential rewards of investing in emerging markets, focusing on sectors that present high growth opportunities. Number 3. Risk of political instability. One of the most significant risks of investing in emerging markets is political instability. In many emerging economies, political systems may be volatile, with frequent changes in environment, civil unrest, or even regime shifts. Political instability can lead to changes in laws, regulations, and policies which can negatively affect investment returns. For instance, nationalization of foreign-owned assets, unpredictable tax policies, and sudden shifts in trade regulations can disrupt businesses, operations, and investor confidence. This section will delve into the political risks associated with emerging market investments and provide examples of countries where political instability has led to economic challenges for foreign investors. Number 4. Currency fluctuations and exchange rate risks. Emerging markets often experience significant currency fluctuations, which can have a major impact on the returns from foreign investments. These fluctuations occur due to a variety of factors, including economic policies, trade imbalances, and changes in the global economy. Investors may face the risk of a currency devaluation that can reduce the value of their returns when converted into their home currency. Additionally, investors in emerging markets may be subject to currency controls or restrictions, further complicating investment strategies. This section will examine the risks of currency fluctuations in emerging markets and discuss strategies for mitigating exchange rate risks. Number 5. Lack of infrastructure and market development. While many emerging markets are experiencing rapid growth, their infrastructure and financial systems are often underdeveloped compared to those of more advanced economies. Poor infrastructure, including unreliable transportation, energy shortages, and inadequate healthcare and education systems, can limit the ability of businesses to operate efficiently. Similarly, financial markets in emerging economies may be less liquid, with fewer investment options and less transparency, making it more difficult to access and manage risk. This section will explore the challenges posed by underdeveloped infrastructure and markets in emerging economies, highlighting how these issues can affect investment opportunities. Number 6. Risk of poor governance and corruption. Another significant risk when investing in emerging markets is poor governance and corruption. In some emerging economies, weak institutions, lack of transparency, and corruption can create an environment where business practices are not conducted fairly or ethically. Corruption can increase the costs of doing business and reduce returns, as companies may need to pay bribes to operate, secure contracts, or bypass regulations. Moreover, a lack of effective law enforcement can lead to challenges in protecting intellectual property and resolving disputes. This section will explore the impact of governance issues and corruption on investment decisions in emerging markets. Number 7. Diversification benefits. Despite the risks, emerging markets can provide valuable diversification benefits for global investors. By adding emerging market assets to a portfolio, investors can reduce their overall risk and increase the potential for returns by gaining exposure to economies with different growth trajectories and businesses cycles. Emerging markets often do not move in sync with developed markets, meaning they can provide stability to a portfolio during downturns in advanced economies. This section will discuss the role of emerging markets in a diversified investment strategy, emphasizing how they can balance risks and enhance long-term returns. Number 8. The importance of research and due diligence. Investing in emerging markets requires careful research and due diligence. Given the unique risks and complexities of these economies, it is critical for investors to thoroughly research local conditions, including political and economic factors, legal frameworks, and market trends. Understanding the specifics of their local market is essential for mitigating risks and making informed investment decisions. Investors should also consider partnering with local experts or consulting with international financial advisors to navigate the nuances of investing in these regions. This section will stress the importance of conducting thorough research and due diligence before committing to investments in emerging markets. Number 9. Long-term investment horizons. Investing in emerging markets often requires a long-term perspective. While short-term volatility and risk can be significant, the long-term growth prospect of these economies can provide substantial returns over time. Many investors in emerging markets are focused on the potential for economic development over the next several decades, driven by factors such as population growth, urbanization, and industrialization. Long-term investors who can weather short-term volatility are often rewarded with significant growth as these markets mature. This section will highlight the importance of maintaining a long-term investment horizon when investing in emerging markets and the potential rewards of patience. Number 10. The role of technology in emerging market growth. Technology plays a pivotal role in the development of emerging markets, driving economic growth and creating new investment opportunities. As emerging economies become increasingly digitalized, there are new opportunities in sectors such as e-commerce, fintech, and telecommunications. For example, mobile payments, digital banking, and online retail are expanding rapidly in countries like China, India, and Nigeria. Investors who can identify innovative companies that capitalize on these technological advancements stand to benefit from the rapid growth in these sectors. This section will explore how technology is transforming emerging markets and creating new opportunities for investors. Number 11. Environmental and social risks. Environmental and social issues are becoming increasingly important considerations for investors in emerging markets. With rapid industrialization often comes significant environmental degradation, including pollution, deforestation, and resource depletion. Additionally, social challenges such as income inequality, labor rights, and human rights issues can create risks for businesses operating in these markets. Investors are increasingly being asked to consider environmental, social, and governance factors when making investment decisions. This section will discuss the growing importance of ESG factors in emerging market investing and the risks associated with environmental and social challenges in these economies. Number 12. Government policies and regulatory risks. Government policies and regulations can have a profound impact on investments in emerging markets. These markets are often subject to frequent regulatory changes, which can create uncertainty for foreign investors. For example, governments may impose trade restrictions, implement new taxes, or change labor laws, which can affect the profitability of businesses operating in the country. Additionally, some emerging markets have a history of nationalizing industries or expropriating foreign assets, posing a risk to foreign investors. This section will explore the risks associated with government policies and regulations in emerging markets and how investors can navigate these challenges. Number 13. Investment vehicles for emerging markets. Investors interested in emerging markets have several options when it comes to selecting investment vehicles. They can invest directly in stocks or bonds, or they can opt for exchange-traded funds and mutual funds that provide exposure to a diversified portfolio of emerging market assets. Additionally, private equity and venture capital are becoming increasingly popular as investors seek opportunities in startups and growing businesses in emerging economies. This section will review the various investment vehicles available for gaining exposure to emerging markets and their respective advantages and disadvantages. Number 14. The future of emerging market investments. The future of investing in emerging markets looks promising. Despite the risks, as global economies become more interconnected, emerging markets are expected to play an increasingly important role in the global economy. With the growth of middle classes, rising consumer demand, and technological innovations, these markets are expected to continue their upward trajectory. However, investors must remain vigilant to the risks involved and consider a diversified approach to managing their exposure to these dynamic economies. This section will conclude with a forward-looking perspective on the future of emerging market investments, considering both the opportunities and challenges ahead. Conclusion. Investing in emerging markets offers both significant opportunities and substantial risks. The potential for high returns, driven by rapid economic growth, technological advancements, and expanding consumer markets, is a compelling reason for many investors to consider these regions. However, the challenges posed by political instability, currency fluctuations, and underdeveloped infrastructure require careful consideration and due diligence. By understanding these risks and rewards, and by adopting a long-term, diversified approach, investors can navigate the complexities of emerging market investments and potentially reap the benefits of one of the world's most dynamic and fast-growing economic regions.